Hello, and welcome to today's session on global listed infrastructure. My name is Tom Toth, Managing Director with Wilshire Advisors. I've been with Wilshire for more than 20 years with responsibility for retirement plan sponsor relationships across public, corporate, and nonprofit sectors. I'm joined today by Andrew Maple-Brown, co-founder and managing director of Maple-Browm Abbott Global Listed Infrastructure. Andrew, with his partners, started the Global Listed Infrastructure Strategy in 2012, which today manages over $3 billion. He's worked in the infrastructure space for 25 years, initially focused on debt financing of direct infrastructure and property assets at Lend-Lease and Macquarie Group, followed by 5 years as a portfolio manager in global listed infrastructure for Macquarie in New York and Sydney. Manoj Patel is the co-head and portfolio manager of listed infrastructure at DWS since 2011, and prior to that was with Brookfield. DWS manages over $12 billion in listed infrastructure assets. And last but not least, Philip Lawlor is a managing director in the market and index insights at Wilshire Indexes, joining Wilshire in September of 2021. He has over 30 years of investment experience managing large multi-asset funds and heading asset allocation at major UK-based institutions. He also spent several years as an investment strategist at a large investment bank. And before joining Wilshire, Philip led the global markets research team at FTSE International. I'd like to start by setting the stage for how investors might think about global listed infrastructure in their portfolios. And Philip, I'll start with you. What role do you see global listed infrastructure playing in a diversified portfolio, particularly for those investors maybe more focused on income?
Yeah, I think we're at this incredibly important inflection point in terms of asset allocation. I think clearly the heightened uncertainty that we've witnessed over the last 100 days has created a fundamental reappraisal of the opportunity sets available. And I think some of those need to be differentiated between tactical and strategic perspectives. And I think from a strategic perspective, what people are now starting to realize is possibly we're seeing the end to some degree of the US hegemony, which means we're looking for more defensive plays. Markets have been very distorted, haven't they, over the last 2 years by the Mag 7 US tech stocks, just the rampant performance of US equities, and that's put pressure on most other asset classes. But if we're now asking ourselves, do we need to rethink the status of business models, courtesy of tariffs? Does this defensive strategy mean we're searching out assets that are going to exhibit strong cash flow generation characteristics and some of that non-correlated returns that you would expect in a classic asset allocation basket? And I think that's where we're seeing infrastructure starting to lift its head above the parapet on this, because clearly the business models behind infrastructure are all about that generation of solid cash flow characteristics, solid EBITDA numbers. So that's not been sexy in the world of Mag 7. That starts to become, I think, a lot more attractive in terms of a world where we're really doing some fundamental reappraisal of particularly US business models over as we see it over the next 2 or 3 years. So the bottom line is, I think we've had a bit of a fallow period, tough period, but against lots of asset classes. But you do wonder if we're now at this really quite strategic inflection point in terms of that positioning.
I appreciate that. And before we get into maybe some more specifics, can you talk about broad risks? What are the investment risks that investors should think about when considering an allocation to listed infrastructure?
Well, of course, I mean, you've got multiple areas, and again, colleagues here will jump in on this as well. But I think from a big picture, what we're now becoming aware of is you can't see it as a homogeneous group. You've got to be now very aware of the regional differentiation as one primary and what goes within that regional makeup. So, for instance, with our our infrastructure index, which we've built in collaboration with the global listed infrastructure organization, you see a very significant differentiation between the makeup of the EMEA, which is predominantly European infrastructure exposures, to the US. So Europe is very much more skewed to renewables. US is much more skewed to energy and has a much higher electric utility exposure. So I think we're now becoming aware that we've got to differentiate, which is going to be driven by that macro differentiation and regulatory changes that we're clearly seeing. Difference in attitude coming out of, as you're well aware, in Washington compared to Europe. Some of these things, the regulatory shifts have to be factored in. Liquidity is the other issue. You need to be aware that if you get volatility, liquidity can sometimes be a positive, sometimes can be a negative. It has a lagged effect. And again, that's why in constructing our infrastructure index, we were looking to make it as liquid as possible, with a median stock having a market cap of 8 billion to provide that liquidity. Otherwise, you can be caught out with a liquidity mismatch.
That's helpful. And Andrew and Manoj, wanted to get your maybe a more granular look at the opportunity set. Maybe I'll start with you, Andrew. When you think about the different sectors within infrastructure, which ones do you find more attractive, less attractive, either structurally or tactically?
Yeah, thank you. So I suppose the first thing to note is we see the reason to have an allocation to infrastructure is really because of its differentiated investment characteristics. For us, that's what drives the rationale for having a strategic asset allocation. For us, those characteristics most specifically are the defensive nature of the assets, so the low cash flow volatility to equity, and also the inflation linkage of the assets. So we're structurally most attracted to the assets which have the strongest combinations of those two characteristics. Indeed, we only invest in companies which will exhibit those characteristics. So in terms of what that means from a definition perspective, about a half of what we look at are regulated utilities. So by market weight, that's particularly electric utilities, to a lesser extent gas utilities and water utilities. About a quarter of what we look at are transportation assets, particularly toll roads and airports. Railway track we include in our definition. We exclude some of the more cyclical assets like ports, for example. And then the final quarter are assets subject to long-term contracts. So renewable assets, telecommunication towers, and pipelines. So that's the opportunity set in terms of what we're particularly attracted to at this point in time. I'm sure we'll go into that, but certainly some of the assets with stronger growth at this time are the electric utilities that have a very exciting future. Some of the mega trends in terms of decarbonisation and AI data centres are certainly driving very strong growth in that sector. And water utilities will probably be the other one with continue to see strong growth.
Manoj?
Great. And yeah, just to maybe add a little more, one space that I think has really sort of resurrected itself in the last 3-4 years has been midstream energy, particularly in North America. And a part of that we really like is natural gas infrastructure. We really see natural gas having a number of sort of demand tailwinds, from coal to gas conversions that are happening across North America and even other parts of the world. We're seeing obviously reshoring, resurgence of manufacturing, particularly in North America, and in terms of restructuring, supply chains. And then, we're seeing obviously a significant amount of development of LNG in terms of, again, North America being, becoming a much bigger exporter of LNG. And then, with a lot of the development in renewable energy, I think, it's becoming obviously even more clear that, you do need to have some balance, in your grid. And I think natural gas really facilitates, renewable energy development because it's clear that, again, the sun doesn't always shine, the wind doesn't always blow. And so again, that's another demand driver, for natural gas. And then finally, and this is something that's just kind of really come upon, right, in the last 18 months, is, we're seeing an incredible amount of demand just for electricity, not even just energy transition, just demand for power, primarily driven by data centers and applications behind in AI and cloud computing. And again, that's, and again, these new sources of demand are 24/7. And again, in order to really help facilitate those needs, natural gas really, has become, one of the primary ways where that energy is being sourced. And so midstream energy is a space that, we, again, really particularly like, and the dynamics are there where these companies are able to get, just better returns on invested capital than you get in other segments of infrastructure.
And Manoj, maybe following on that and shifting tax to kind of current regulatory framework, how do you think the policies of the Trump administration might affect listed infrastructure, particularly around deregulation or tariffs or other energy priorities?
Yeah, I mean, it's, in the short term, it's probably a mixed bag, right? To be honest, right? Just the uncertainty, related to the tariffs, and now maybe some economic uncertainty, behind that. So, I think that's probably sort of a short-term situation that I think, all market participants will have to deal with. But when you sort of look at the other side, and you look out, 2-3 years down the road. There's a few things that, one particular thing that you mentioned, the deregulation, and I think, this administration is about building, is about infrastructure development, and also, really facilitating private capital as a part of that, not completely dependent on just government spending. So I do think that element, I think, helps all infrastructure across sectors. And then I think the other element, and then we'll see again how this tariff and sort of trade imbalances and how they get resolved. But, it does seem clear that there is a focus on moving more manufacturing back to the U.S., having more of a supply chain, maybe within North America. And of course, that's going to create, a number of opportunities, within infrastructure, again, across all sectors, not just utilities, not just energy, but even in communications and transportation.
The one thing I would just interject there, again, from a bigger picture, is the market is starting to differentiate in terms of the macro backdrop. It's starting to think about the US facing a slightly more stagflationary backdrop. But on the flip side, and this explains the big differentiation in performance, Europe is looking at a more reflationary outcome, particularly driven by Germany, where we've seen the scale of their planned infrastructure investment, which is on averaging 10% of GDP per annum for the next 5 years. So there is possibly behind the scenes some sort of recalibration going on in terms of where those that.
Yeah, I mean, and just part of that, I think what we've seen just year to date is really, we saw just a huge, dispersion in returns, right, of U.S. Even within infrastructure. We saw it in private markets, but we definitely saw it in within infrastructure. U.S. companies tended to have done better. Europe, particularly last year, was really hit, in terms of just kind of a economic uncertainty and some elections and a variety of other things. And so I think what we've seen year to date is just a rebalancing and just a reversion. But as Philip said, I think the outlook is definitely, much more bright in terms of Europe. There does seem to be, more optimism in terms of development on a number of fronts. What we've seen, particularly, the news on Germany and some of the fiscal, spending that they're looking to do.
Perhaps the other point, I suppose, on the US is, and agree with Manoj's comments that there is uncertainty, obviously, But the benefit the infrastructure sector, in the main has is that the significant majority of the businesses are domestically based, so it doesn't face the same exposure as many other companies. And on top of that, a lot of the businesses earn regulated returns. So even to the extent that their costs do rise, those costs are effectively being able to be passed through to customers. Probably the other area of uncertainty, though, that on the other side, on the flip side, that I'd flag is in relation to the Inflation Reduction Act. So that's probably still the piece where we still don't have good visibility as of yet. But the impact of that, which is really around the tax credits on renewable assets, is still pretty limited from our perspective, particularly around regulated utilities. The impact is very small. On top of that, at this point in time, I'd suggest that there's a lot of uncertainty as to how much that will be repealed, and even to the extent it is repealed, there's provisions like safe harbouring, which will likely mean that the impact is not felt for a number of years anyway. So I think overall for the infrastructure sector, whilst there is uncertainty there, the impact is not particularly significant.
Fantastic. Switching gears a little bit to talk about relative valuation. Andrew, can you just dive into what you think is driving the gap between infrastructure and global equity? We know how well global equity is done, particularly in the US. And what do you think this new environment might mean for those valuations reverting? And then I'd also like to get everybody's input on what valuations look like relative to private infrastructure. The institutional investment space, private infrastructure is a very hot topic. Many plans are growing their allocations there. And I'm curious what kind of implications that has for global listed infrastructure.
Yeah, absolutely. Firstly, in relation to global equities, we certainly believe, based on historical multiples, that the listed infrastructure sector is significantly cheap relative to global equities, relative to where it's traded historically against global equities. It's hard to know what's driving that. But part of that has obviously been the very strong performance of a small number of tech stocks, but it is broader than that. That only explains a portion of the valuation difference. I think it's been driven predominantly by the excitement of the growth of some of the other areas of the market over the last several years. But what I think people have underappreciated is how much growth there's also been in what have been historically pretty boring infrastructure and utility type companies have been growing very strongly. And so it's that combination of having underperformed the market for a little bit whilst at the same time themselves growing very strongly that we've seen this valuation gap emerge. It has certainly started to close. The sector has performed very well this year, but there's still a significant gap not based on our numbers. What's even stranger, though, which is the second question from my perspective, which is that the valuation of the listed infrastructure market versus the private markets in infrastructure assets. From our perspective, they're the same assets. They're subject to the same regulation, or they're subject to the same dynamics in relation to users of those assets. But at this point in time, we believe that the listed assets are trading at significant discounts to where the equivalent assets are trading in the private markets. And I think that's purely a supply or it's demand driven. There's been a lot of money that has flowed into the private sector, which is really being attracted by the apparent lower volatility, which from our perspective is really just driven by the valuation methodologies. The listed markets value their assets every minute of every day. Whereas private markets are obviously valued less regularly and valued by a model. So that apparent lower volatility has driven that current demand for the private assets. But we think that creates a real opportunity for listed markets, both for listed companies to take advantage of that valuation gap. They themselves are growing rapidly. There's a huge investment need for these listed infrastructure companies. So instead of funding that through issuing equity, they can take advantage by selling assets or selling stakes in assets to the private markets at higher valuations, to enable that organic capital expenditure to be more accretive. And in some cases, we'll probably see companies being taken private, which again is a positive for the investors within these companies.
Manoj, anything you wanted to add to that?
Yeah, no, I think Andrew covered that well. I think this discount has been there for a while, and I think there's periods of time when it's wider, or even more narrow. It's probably kind of in the middle of the fairway right now. Again, I think depending on what sector, what region, you're talking about. I would say that listed probably, the valuations that you can buy of listed infrastructure companies today is probably somewhere between 20 to 40% less than, equivalent assets that are marked in private infrastructure books. We could spend an hour talking about why that's the case, but I just think, and there's now a growing amount of maybe evidence to show that. And one of the things is, what Andrew just mentioned, we've seen a number of transactions where listed companies have sold partial stakes in existing assets or even sold their non-core assets at significantly higher valuations than what the underlying, listed company is trading at. And so, again, these are same assets. I would even argue that, the average quality of a listed infrastructure portfolio is materially higher than what you would get in a private, infrastructure portfolio. And of course, all the other benefits of the, diversification, the active management, and again, the access, to the opportunities. As I mentioned, the energy side is an area that I think, again, has done really well. Obviously, that wasn't the case, 5-7 years ago. And okay, when you're allocated to listed infrastructure, again, you can take, even though these are long live assets, there are cycles, within regions, there are cycles, across sectors. And I think that, if you're going to be allocated to infrastructure, you want to have that, level of flexibility in some part of your allocation to that overall asset class.
And Philip, can you talk a bit about what kind of demand are you seeing on the listed infrastructure side? We talked about the growth in private assets.
This is from our perspective in terms of our conversations with clients. We're getting a lot of interest. We've had good take up already. So there seems to be a lot of genuine interest in certainly in the index benchmark that we've developed with Leo. So that is evident, I think, this is from an asset owner sort of standpoint. They're still very keen on this. They're very keen to participate. They're looking to increase allocations. We've not been up and running with it for very long, but the uptake so far has been very, very positive. So I think that's a very good indication. I think this just goes back to that earlier point we're making when we're comparing the valuation of infrastructure to equities. When you understand equities, particularly US equities, are most probably facing two big strategic headwinds in terms of understanding that if there is a risk of more elevated inflation than was otherwise thought, inflation is very damaging to valuations. And also what you're possibly seeing is realizing that US equities were starting to discount too high a long-term growth rate of EPS. And as that compresses to more realistic assumptions, together with possibly some further rundown in valuations, asset class, going back to this differentiated long-run asset potential, you want an asset class that has got the defensive properties of having really nice defensive cash flow properties, which is what I think a lot of our clients are looking at infrastructure quite seriously now. I think we're sensing people feel this. We have seen this. We are witnessing, as I said, quite a major inflection point.
Mm-hmm. There are two other topics I want to make sure that we touch on, and that's the reshoring and onshoring. Andrew, you brought that up earlier, and the digital infrastructure boom. But starting with the first one, Andrew, what types of assets do you think are most critical to supporting that growth in onshoring? And are there specific regions that you think are likely to benefit more or have higher demand?
Yes, certainly from our definition of infrastructure, the way we best play that is through the regulated electric utilities. In terms of the result of that onshoring and indeed the result of the AI, the data centers, is a significant increase in electricity demand. And we're already seeing those forecasts come through, and the forecasts are likely lagged. But for the last 20 years in the US, you've seen electricity demand grow at less than 1% per annum. The most recent forecast over the next 5 years, it's going to be growing at 3% per annum. So a significant step up in the electricity demand, and that's coming from those reasons that you're talking to. So in terms of how to best play that, in the US, there are certain states which are regulated electric markets from a generation perspective, and there are certain states which are deregulated, which have competitive power price markets. So in terms of playing the utilities, which are most exposed to that growth in electricity generation, you want to own the regulated generation. So you want to be invested in the states which are regulated generation markets. In addition to that, you obviously want to be located where you're seeing that growth. One of the regions which we've seen some of the strongest growth is down in the South Energies region. Louisiana, Mississippi has been seeing some strong growth, both in terms of from the growth in manufacturing, but also the data centers. Similarly, some other southern states and also up into the Midwest are some of the regions where we're seeing, at this point in time, the strongest electricity demand growth coming through.
Manoj, what's your perspective on, I'll say, regional differences in the onshoring and reshoring?
Yeah, absolutely. I mean, I think Andrew sort of, nicely laid out, there are definitely markets that, are seeing more development of data centers, definitely more reshoring. You could probably characterize that broadly as kind of like the Midwest and the Southwest and Texas. And I would say, from an infrastructure standpoint, there's obviously a spectrum, within there, right? There's the utilities regulated utilities that, Andrew talked about, and, you could think of that as kind of the core and, where, lower risk, but lower return, but very regulated, very safe. And there are other elements to play sort of, these themes, particularly on the digital infrastructure side. One is just, digital infrastructure itself, which people broadly define, including data centers and towers. And data centers, again, depending on who you talk to, some people think of it as infrastructure, some people think of it as real estate. But, it's obviously been an area where there's been a lot of activity. There's been a lot of capital coming in. And one thing I would definitely, tell the audience here that, that given where we are in the cycle, there's a chance that, data center, investment could go by the way of renewable energy, right? And what I mean by that is that, for the last 5-7 years, we've seen an incredible amount of investment on the renewable energy side, but, the returns, have not been that great because it's a very competitive business. It's a low return on capital business. And, I don't think investors have really made a lot, of return in that space, even though there's been a lot of investment that's happened. And there's a chance that, data centers could kind of go down that path too. There's a lot of capital, there's a lot of public companies, there's a lot of private companies, there's a lot of real estate companies. That, every other week it feels like a new data center company is being formed. And so, so it is important to kind of understand, where we are in the cycle, and again, where what the sort of forward-looking returns are going to look like versus what they've been in the past. And then just to kind of finish up, kind of in the middle, between the data centers and the utilities is just, again, the sources of electricity and some of this can be regulated, some of this can be unregulated. And some of this is also kind of, as I mentioned earlier, just on the midstream and natural gas side. And again, so there's definitely a spectrum of opportunities. And, I would say that, depending on what you're looking at, that there are likely to be changes in forward-looking returns on capital than what was realized in the last few years in this space.
Sticking with digital infrastructure for a second, can you talk a bit about how listed infrastructure companies are addressing the challenges of scaling the networks needed to support the growth there? They're from an operational perspective, how are they attacking that challenge?
Yeah, I mean, it's particularly, since we're broadly talking about the U.S., but again, this probably, applies to Europe and other markets. There's not really a centralized plan, right? Particularly the U.S., you have different states, and there's different environments, and then obviously the tech companies which are driving obviously all of this investment, each all have their own plans, and they're all at different stages of their build out and what they're looking to do. And so, I think for the short term, it's kind of, to be honest, a bit all over the place. Again, some states have really, made policy decisions to facilitate renewable energy. Some are now trying to push back on not renewable energy, on data centers. And some are trying to push back because now they're starting to see some constraints and capacity is being fully utilized and in terms of on the power side. And so I do think for the next several years this sort of environment's going to probably continue. And then I think once you get towards the end of the decade, once the supply demand picture probably looks a little bit more balanced, and you have more data center development, you have more power generation development, you have more grid development. I think it then starts to look a little bit more cohesive. But for now, again, I think things are going to be a bit more and potentially volatile, particularly if we're kind of move into maybe a recessionary environment, in the short term. And so, but I would say that's broadly an opportunity, I think, for investors and to take advantage of potential dislocations and where there could be big differences in return opportunities.
And Andrew, speaking of different return opportunities within digital infrastructure, are there certain subsectors that you find have more compelling growth prospects as we move through 2025?
Yeah, we certainly agree with the comments that the data centers, yes, there's a lot of investment opportunity there, but it's also a very competitive sector, and the returns are more difficult to forecast. So we exclude that sector from our definition of infrastructure. What we're most excited by all that's going on is really the continuing strengthening position and importance in society of the telecommunication towers. The towers have very high barriers to entry. It's a mature industry. They're already built and developed, but it's very difficult to build new towers. No one wants a new tower. They're large physical structures in their local community unless they're absolutely necessary. So that's a great asset, considering the only increasingly importance that they play in society. They've always been, in our view, some of the strongest infrastructure assets. The challenge historically was that they used to trade at quite high valuations. Towers has been a sector which has really underperformed over the last 4 or 5 years. And so from a valuation perspective, we're quite excited about the opportunities both in Europe and also the US from that sector. Yeah, and I would say even, we're starting to see even a little bit of a inflection, in just fundamentals in the space. Just today we had two of the largest tower companies globally, but based in the U.S., reported. And, again, I think we were kind of on top of sort of a tougher environment the last few years. I think fundamentals in the space were also kind of
maybe kind of weak or not as robust as they've been in the years past. But we are starting to see an inflection point there.
Mm-hmm. Any comments on relative opportunities in emerging economies versus developed? Are you seeing divergences there, one more or less attractive in the current environment?
I can touch on what just kind of our views. I would say within emerging markets, it obviously, again, just like other things, it's kind of a mixed bag. Where the markets that we probably like a bit better, where maybe the returns on capital have been a bit more consistent, the sort of the regulatory environment has been a bit more stable or even very conducive to private capital, has been in India and some select markets in Latin America and South America. So I think most people understand the India story, and there's a lot of obviously different growth drivers with demographics, and then even now with maybe the North U.S. trying to shift away from China, that sort of probably the net beneficiary not only to India but even other Asian countries. And so we're seeing a lot of development in India, and on the infrastructure side, a lot of this is being done by private capital. That was a market that had a lot of challenges about a decade ago, but I think there's been a lot of reform from a regulatory standpoint, and having that stability of government has really sort of accelerated a lot of this private capital infrastructure development. And you could probably say the same thing, in again, some parts of South America. And Brazil's a market that I think is right now probably just kind of recovering from some just some inflation and political issues. But we do think that we do think the regulation has been broadly stable even throughout this period, and we do think that there's a number of select kind of opportunities in that region.
Yeah, and we agree that the emerging markets is very exciting in terms of the size of the infrastructure opportunity there, in terms of the investment needs. The challenge we find though is looking for assets which have those combinations of low cash flow volatility and natural inflation linkage. So we tend to the regulatory regimes tend to be less predictable and stable, and the legal positions can be more challenging. So from our perspective, it tends to be a smaller portion of the portfolio, and certainly the individual position sizes are smaller for the EM.
Mm-hmm. And and you don't have to. It's also important to understand you don't have to invest in emerging markets to benefit from emerging markets growth, right? If you just even look at again, kind of going back to energy, what drives most additional energy consumption globally is emerging markets. And if you look at markets like the U.S., which is becoming more of an exporter market of energy products, of hydrocarbons, liquids, natural gas, most notably, and sort of related products, distillates from there. Most of that export growth is again pretty much driven by emerging markets. And so there are ways to sort of capture those opportunities in assets that are in developed markets, but maybe some of their fundamentals are driven by the growth in developed markets and in emerging markets. So.
And before we get to some audience questions, I think I'd be remiss if I didn't ask for your opinion or what you're hearing from your companies around current events, particularly Spain and Portugal, with the blackouts that they've had there. What does that mean for the infrastructure space broadly? But if there are specific implications for listed infrastructure, given that event.
I think it just reminds everyone of the importance of reliable infrastructure, reliable electricity networks, are as important as affordable and green networks. You need to provide all three aspects. So yeah, it just needs further investment from our perspective, which is a positive for investing in regulated infrastructure assets.
I mean, people aren't certain what the causality is, but the inference is it was something to do with excess solar. In which case it's emphasising the need for diversification within your energy sourcing. So again, I think that's going to be, if that is the cause, that I'm sure is going to be a catalyst for quite a lot of proper rethinking within Europe.
Great.
Yeah, absolutely. I mean, again, I think having a practical approach, towards infrastructure is important, right? It's really dangerous if you kind of go really one-sided in sourcing all of your energy from one or two areas, and even again, even in transportation, having robust infrastructure, having balance and practicality, I think is important, and I think events like this probably, hopefully remind policymakers, of the need to be balanced in the way they approach infrastructure, and also obviously create the environment, for private capital to help develop, these infrastructure needs.
Fantastic. I think in the few minutes that we've got left, we'll do a couple of questions, and again, everybody feel free to jump in. Given the amount of dry powder waiting to be deployed in infrastructure, which is estimated as much as $300 billion, should investors look to listed infrastructure as an alternative or a place to park capital while they're waiting to deploy into the private space?
Yeah, we certainly think listed should definitely be looked at as an alternative. As both Manoj and myself said earlier, we think the assets, they're the same assets or potentially even high quality assets, trading at a significantly discounted valuation, and also with the benefits of the liquidity can provide to investors. So we absolutely view that they should be listed should be an alternative for investors. In terms of as a place to park capital, it does. I'd suggest it does depend on your time frame. So we don't encourage people to put it in for a 6-month period, for example. But if you're looking to get an infrastructure exposure over multiple years, then absolutely we would think that a very wise thing to do whilst waiting to invest in private.
It should definitely be seen as more of a strategic investment rather than a short-term rotational investment.
And maybe just as a follow-on to that, and the last question I think we have time for. So over a medium to long-term investment horizon, however you might define that, 5 to 10 years, in your opinion, does listed infrastructure provide the same total return as private infrastructure?
I can start there. Absolutely. I would say that that's been the case already. You look at obviously what happens in the listed infrastructure is an open book. Everything we do is just quite transparent. But there's a few private market benchmarks out there on infrastructure, and you look at the long-term returns. There's no significant difference. Obviously, because you have daily pricing in listed infrastructure, it has this perception of higher volatility. But I'm happy to argue that that's not the case. In fact, you can argue that there's more vol just because you might not exactly know what the true value of your assets are if you had to liquidate on the private side. But yeah, and the other thing that I think is important, and we touched upon earlier, is again your sort of your cost basis is, I think, theoretically lower today in terms of listed infrastructure. And then probably the final thing is that you're also fully invested. And again, that's, I think one of the things that's sort of challenging when you sort of compare listed with private is nobody can exactly replicate a private index, right? It's sort of an aggregation of a variety of things with, some theoretical exercises in between. And so, and you don't know how much money, you're actually fully invested, and when you get capital calls and when you get monetizations versus, again, in listed infrastructure, you can be fully invested, but you still have all the flexibility to add or reduce, your allocation to the space.
If I could quickly just add to that, I totally agree with all that, but ultimately they're the same assets in private and listed. And we've done research into whether either the listed or the private markets are better operators of infrastructure assets, and we don't think there's proof either way. We see circumstances where listed operators are better, and then we see circumstances where private operators are better. But on average, they perform very similarly operationally. So in terms of what could cause differences in returns, I think there are two key factors. The first factor is that private infrastructure investors utilise more debt, generally speaking, and that has been a benefit to private infrastructure over the last 10 or 20 years when the underlying asset returns have been high. So as to whether that will be a tailwind or a headwind over the next 10 or so years will depend very much on the, interest rates have also been very low over that historical period. So looking forward, it will depend on the asset returns versus the interest rates as to whether that will be a tailwind or a headwind. And the second key factor is the price that you buy the assets at. At the moment, as we've discussed, the private assets are being bought at significantly higher valuations. So in terms of whether that will be a tailwind or a headwind, if they, in order for it to be a tailwind for private assets, that the gap between private and listed will have to continue to widen further. We think that's quite unlikely, considering that the gap they're already at. We think far more likely is the valuation gap actually closes, which would be a tailwind for listed. So I think they're the two key main factors that will determine as to whether private or listed outperform over the next 10 years. But at the end of the day, they're the same assets, so the returns should be very similar.
Excellent. Well, let me thank all of our panelists for spending the time today to give their perspective on the listed infrastructure space. I hope it was helpful for participants and gave you some food for thought as you think about how listed infrastructure might play a role in your portfolio. Thank you very much, and everybody have a wonderful rest of your day.
Thank you.
Thank you.